Okay, welcome. Thank you everybody for giving us your attention. It's our first experience coming to one of these. Looking forward to talking to you about Built Cybernetics. We've been on the market for a very long time. We were known as Aukett Swanke, which was an architecture business, and we've transitioned to be a PropTech, and would like to talk to you about where we're at on that journey. Usual disclaimer, but I guess I would just flag up that compared to the two businesses that you've heard from already this evening, we are a much smaller business. So we are on AIM, but we're one of the smaller firms on AIM. We hope to change that, but we are higher risk than most quota businesses, so this won't be suitable for everyone. We do think it's quite interesting, but your own circumstances will dictate whether we're suitable for you. So, revolutionising the built environment by designing, delivering and operating smart, sustainable buildings and spaces. I'm going to talk to you about what we mean by that, and what we're doing and where we're at. So this is what we're covering today. Really, there's 4 sections. The first 2 are long, the last 2 are pretty quick. So I'm about to cover what we mean by smart buildings, what the problem is, what our fix is, and appropriately for London, we have a tube map of opportunities rather than a roadmap. Freddie is then going to cover where we're at financially and what's in the group now and how we're going to grow. And then I'm going to just quickly zip you through the current ownership structure, some interesting stuff around staff supporting the business, and cover the key reasons to invest in the group. So smart buildings, when you think about what is a smart building, there's no one definition. It's a term that gets bandied about. Here is a definition we find useful. A smart building is designed around its occupants. It uses technology to deliver useful and consistent experiences, as well as space and energy efficiencies. So if you get smart buildings, it follows you must have dumb buildings that are not that smart, and also that you can perhaps move beyond and have intelligent buildings that are smarter buildings. It is really a spectrum of what a building can do for you and how well run it is. And most buildings in the UK and the world are very dumb. You tend to get lots of, for example, rules-based behaviour. So I mean things like if you were to wander around the city on a bank holiday, Monday, you'll find an awful lot of lights on in winter in the daytime and heated buildings. And even though there's no one there, because it's just following a rule like your central heating system at home, there's no going and polling the government API to see if it's a bank holiday or not and turning off the lights if it's an empty building. And then you kind of converged infrastructure is sort of where a lot of smarter buildings are at. And essentially we're moving through, as you go from left to right, to eventually buildings which are essentially run by artificial intelligence. But it's not the artificial intelligence that is giving you a plausible explanation. It's not a large language model. It's precise AI that is looking at data and taking decisions and working out what the best thing to do is. And if you ask it to do it again, it'll give you the same answer for the same outputs, and it will take consistent, accurate, explainable decisions and not simply invent stuff the way that LLMs do. So just the reason why you might want smart buildings. At the moment, technology is siloed. There are lots and lots of different building systems. They're often networked, but they don't talk to each other. They just sit on the internet and they go and do their thing, and they don't give you much information other than to the specific people who work with those systems. And if you were to share data between systems and with different users of the building, you get a much better experience. And that means if you're a landlord, you can charge more. If you're a tenant, you can get a better building that's cheaper to run. And if you're a user of the building, you get a better experience. So one of the reasons that it's hard to get smart buildings is that landlords do pretty well out of property. famously, and there is not a lot of need to change. And so they tend to be behind the curve. Property tends to be quite slow in terms of the rate of adoption of technology. One of the attractions of being a public company is that we can be a sort of permanent fund, and we're not tied to venture capital cycles. There's an awful lot of venture capital gets burnt in PropTech expecting to be able to show up with a whizzy bit of software and just walk in and sign everyone up, and life isn't like that. Landlords and property owners are rightly cautious about just signing up for the latest thing that bowls in the door. Buildings are, the technology in buildings can be fragile, and there is a huge issue around the cybersecurity of building systems. At the moment, people think about cybersecurity as protecting their data. They don't, and there are lots of examples of building systems getting hacked as a sort of backdoor into the data. But increasingly, bad actors, potentially bad state actors, can hijack buildings that are not secure and use them to essentially conduct terrorism. If you were to have a skyscraper, for example, and you can interfere with the access control and with the heating system, those sorts of issues need thinking about, and at the moment they're not properly considered. If you were to go into a large skyscraper, somewhere there is a room that probably has no windows, and inside it looks something like this. And these are all the discrete systems in the building that currently don't really talk to each other. And so, for example, if you wanted to get data about energy intensity, you need to understand who's in your building. You need data from the access control system, and you need to look at the metering system, and you need to kind of perform a manual calculation with this sort of system to get any kind of data about energy usage based on the number of people in the building. In a commercial building, typically, if you think about who is the business that's using that, the building is usually the energy costs are kind of 1% of the business's costs. The space is 9%, and the people is 90%. And what that means is that while smart buildings often start around energy saving, because it's good for the planet, saves you some money, quite easy to demonstrate a return, actually you can get a tremendous return on getting a space that's better for people, that they will enjoy more, that they can use more efficiently. If you're a lawyer trying to get to the 18th floor of your building, then getting you through the lifts quickly in the morning can save the company a lot of money. Based, even 1 unit of your time is a meaningful amount for each of those lawyers. So our fix to all of this is SmartCore, our building operating system. So a bit like a computer operating system, but for a building. It sits on top of all of the other building systems, and it normalizes the data, and it passes data appropriately between the systems, including between landlord and tenant systems. And the goal is to give people complete agency over their buildings and spaces so they can create an excellent experience for everyone by default. So we talked about how at the moment, that picture of the discrete systems, that if you can get them talking to each other, you get a much better experience. You can certainly make them more efficient to operate, which is good for good business and good for the environment. The other challenge is that buildings last for many decades, maybe even a century. And if you've only got to look at what's happened since the pandemic with the change in work patterns to see that you need some flexibility, and the use of technology can make that easier and much more effective. And the other issue is that things like software has a relatively short lifespan. If you look at software from 10 years ago, it mostly looks pretty terrible. So there's that mismatch between property lifespan and software lifespan that you've got to bridge as you become, as you get your buildings more technically enabled, as you make them smarter. The user groups that we consider are the developers, of course, are very important. You've often got to persuade them and help them understand the benefits of having a smarter building. and the operators of the space, but also the tenants and anyone who uses the building wants to have a better experience. But also the service providers. So, for example, design consultants, some of the accreditations like NABERS, which is a standard for measuring how buildings perform in use instead of just how they're designed. It's essential to have feedback about what happens to the building, how it's actually used to create a sort of feedback loop so you can go back again and improve design of the building of further buildings. This is what SmartCore looks like in use. This is the software, and so you can see various building systems there, and they're all talking to each other. This is showing quite a lot of systems in a building. There's a bit of a buzzword called single pane of glass, which is this idea that you can see everything on one screen. But in reality, there's no one person who needs to see everything about a building. We tend to talk about suitable panes of glass, and the idea that you want to get the information that's right for you, and that if you're the owner of a portfolio of properties, you want some aggregated data. If you're a tenant running one floor of that building, you want very specific information about your site, and it wouldn't be appropriate for you to see data about the other parts of the building. And SmartCore handles all of that and passes data in a GDPR compliant way between landlords and tenants and between tenants. SmartCore is currently in 2 million square feet of buildings worldwide, from Mumbai to Manchester and Shanghai to Santa Monica. We have a growing presence. It's not huge yet, but that's where we are, and we look forward to expanding that over time. So this is just demonstrating what you can do, just to demonstrate the low latency nature of control. But this is essentially playing Snake on a building in Birmingham last year, using the lighting system and demonstrating how quickly you can control elements of a building, and the way that SmartCore can automate your building. So I think I've touched on this. Essentially, it is about securely and appropriately connecting landlord and tenant systems. There's not a lot of thought to how it's done at the moment, and it's often done in a way that is not secure and not appropriate. We have a fair few clients in the city who are law firms, and it is the law that GDPR is a thing. Visitors should be able to exercise their right to be forgotten. You go and ask most landlords how they're handling that, and there's a sort of shrug. This is our tube map of opportunities. So this is the different. So for example, everything in light blue here is around user experience. So things from like visitor management and the AV systems and wayfinding. There's facilities and smart operations, and the intersections are features that are in one or more, in more than one area. And so if we're able to buy strategically, we can pick a particular cluster as we grow. And if we have to buy opportunistically, it might be we join up the dots differently, but depending on our share price performance and what opportunities we can find, that's the sort of the map that we're filling out. So now I'm going to hand over to my colleague Freddie, our COO, who's going to talk about our progress to date.
Cheers, thank you, Nick. And I think that was a good overview of smart buildings as a whole and part of what we are doing at the moment. But I'm here to talk a bit more about AIM's best kept secret at the moment and how we've got to where we are over the last 2 years. So previously, this was a purely architecture firm. It's been on AIM since 2006 and it floated in 1988. And this is all about our transition from what was an architecture business and historically has been to more of a smart buildings one. And that's where the real focus has been since me and Nick joined, which was just over 2 years ago now, which was when ASG, now named BUC Cybernetics, acquired Torpedo Factory Group in a 60-40 share-for-share merge. From that point onwards, we started wanting to fill in the tube map that Nick alluded to earlier on. So in July 2023, we acquired Anderson Kern Limited, which were a smart buildings distributor of software and audiovisual. What really sort of stands out for us there is it can start to distribute some of our own internal IP, such as SmartCore, which Nick has alluded to there, and I'll go into a bit more depth on EcoDriver and Kahoo in the later slides. October 2023, we acquired EcoDriver, which is a energy consultancy and analytics platform, mainly for shares, partially for cash, and it supplies the EcoDriver platform, which I'll come on to shortly. And then in March 2024 was the acquisition of Vanti, which is now the name of one of our main trading subsidiaries. And this is a master systems integrator, and it's got the proprietary software of SmartCore, which you've just seen, and Kahoo as well, which we picked up at an absolute steal after speaking to the owners of the company for multiple years. They had valuations, I think, around about the 10 million, 12 million pound mark, and we're looking to raise money at that before, due to various circumstances. They slightly overdid this on the overheads and run rate of business. And in September 2024, we disposed of our freehold property over in West London in Acton, just to simplify our operating and geographical structure in terms of where we fulfill all of our business. So group brands as of today. So from a technology point of view, we have Vanti Limited, which has the SmartCore software there and is a master systems integrator. Torpedo Factory Group is a master venues company, and it's very similar, but instead of more of the commercial properties and stuff, it's educational and theatres. And then Anderson Kern, which is the distribution business for smart technology. The software that we built up over the last 2 years is EcoDriver, the data analytics for energy, SmartCore, which is the building operating system, and Kahoo, which is more of an asset management, efficiency of the building, utilising the space and access controls. And then we've got the heritage businesses of Aukett Swanke and Veritech. And with these two, it's hard to understate just how much they help with the entire process of all of this. What we're looking to do with these buildings is have a touch from building inception, which is the architecture state of things, designing, help to construct the building, where we then open up the opportunities elsewhere to integrate this technology within the building and have a touch to end building life with the recurring software revenues and maintenance revenues that come off the back of this. So moving on to quickly EcoDriver, which is another one of our internal IPs. And this is the decarbonisation platform, and it captures energy data within the building. Most people or commercial aspects that get involved in this typically have a return on investment within 6 to 12 months. And really helps with energy consumption and running that business. What we've done, which is a bit more exciting over the last 6 to 12 months, is implement EDDI, which is the EcoDriver Data Intelligence Engine, and it's an AI sustainability assistant. And this, in real time, looks at your data, your analytics from the business, and helps you make the right commercial decisions with that. I think with integration with SmartCore in the future, this could be more of an automated piece of technology that can make those decisions for you. But we've made the first interesting steps along that road. Moving on to recent results. So we've got a 30th of September year ends, and we've had an increase in our revenues from 14 million to 19 million over the last financial year. And a much stronger second half in which all of the losses were encapsulated in the first 6 months. And we've seen a continued uptrend in terms of viability of the business, profitability and turnover as time has gone on. And the smart buildings plan has just begun to have fruition. I think at this point now, some of the things to really look at is the type of revenue that we have. So over 2 years ago, this was purely architecture revenue, in which from investors like yourselves, it's not an exciting element to be in. 55% of this is now smart buildings, PropTech, and recurring revenue. So when we look at this 20 million revenue stream for the 24 financial year, 2 million of that is recurring and software driven as well, based on SmartCore and EcoDriver. We have not quite the size of the previous companies that you've been looking at, but we've got net assets of 2.4 million on the balance sheet. A lot of that is goodwill and intangibles, but there's also undervalued investments there in Germany, architecture businesses based in Berlin and Frankfurt. So financial highlights. revenue up 39% over the last financial year. The majority of this, 10.2 million now, is smart buildings. The 0.5 million loss that you see in these results is confined to the first half. So the second half of the year, it's begun to wash its face and is profitable before PLC costs. And we've reduced our net debt through the building sale by 88% to just over £250,000. Current financial year's trading started really well. We've got excellent work in progress and order books at the moment, which are at all-time highs. So highlights from an operational and shareholding perspective. We've had our first sale of the Smart Core Enterprise license, which Nick has gone into detail on earlier. So historically, this has been more of a recurring revenue. We integrate this within buildings, and then there's service revenue that comes off the back of it. But the first enterprise license we sold for £200,000 a few months back also has the recurring revenue off the back, and we're in multiple opportunities at the moment to do this further. We've integrated all of the smart buildings acquisitions onto the same ERP system now, which is Q360. We're the only company in the UK to utilise this, but it's very big in Northern America for the audio-visual and smart building sorts of firms that we're talking about. That's led to really good synergies with staff who can now operate seamlessly across all of the individual entities that we have. Sale of the West London property, which I've discussed, and the launch of Eddie, which we've gone into some detail on as well. Company name change a couple of months ago now, so we are now built Cybernetics. We're no longer an architecture firm. We're focused on being a PropTech company and looking to have share valuations that are more associated with what we're doing as opposed to what we've historically been doing. And we've got staff continuing to purchase shares on our internal share schemes, ASOP and MSOP, and Nick's going to give it a little bit more detail of that in the upcoming slides. So, our growth strategy, it's a multifaceted approach. We're targeting market cap of 50 million in a short time period. What we need to do is have acquisitions to reshape the group profile. Looking at that tube map that Nick put up earlier on, starting to fit in more and more of those elements so we can have a touch on a building from inception to completion with more revenue streams off the back of that. And from a software and recurring revenue point of view, it just helps us scale much, much faster. From the software element, pure architecture firms in the past, if you're scaling the revenue, you need to scale your overhead costs accordingly. What we're doing nowadays really doesn't depend on that at all. So we've got some strategic partnerships at the moment in artificial intelligence and operational technology, especially on the cybersecurity side of things, which is more prevalent by the day. And cross-selling in the business has been fantastic. We saw synergies there 2 years ago when this started, and it's just been way, way more than that. In terms of the legacy architectures, heritage that we've got there in the business, doors are opened up for these technology opportunities and these integration projects at a much, much earlier stage. I think with the Vanti acquisition, we had a best part of £750,000 job. They've been trying to get over the line for the last 18 months. Within a few weeks, we used the architecture directors that we've got there in Aukett Swanke Limited. They opened the doors and the contract was signed within a month. So that's all been fantastic thus far. And I think back over to Nick to go through some of the ownership and management.
Thank you. So, just briefly, I felt I couldn't promote the company in any way without making clear that our long-term share price does not look like the two other companies that we've seen. We are we were floated in 1988 as an architecture firm. This is the share price to 2023, when I think everyone agreed they'd proved that it is a bad idea to float an architecture firm, and a change of strategy was needed. So really the period I'd like you to look at is the period since the TFG acquisition, when we switched to smart buildings. There was a shareholder who'd come in on the previous, when it was an architecture business, who significantly sold his shares, and that pushed the share price down to a low just around here. And then the shares went up 80% last year and are ahead again this year. In the last few weeks, they've risen further. We're still below the level at which Freddie and I swapped our business for shares in the PLC. The shareholder base at the moment looks like this. So I am the largest investor. Freddie and some of the other board are over on the right. We have just announced that we're exercising some warrants, which will see our shareholdings rise. The other main holders, Philip Milton and Jim Mellon, are two investors who've come in with the new strategy. Nicholas Thompson is my predecessor as CEO of the public company. Highlighting him because I think it's people often are a little concerned when they see an ex-CEO with a large holding, but he actually owns more shares now than he did when he ran the company, and he's been he was sort of instrumental in plotting the move to a new strategy, and it's very supportive. And then we have quite a lot of retired employees, and then there are increasingly some other employees. I'm going to talk about how they come to be there as shareholders. The management team, not a very diverse looking bunch, but we're all in our 40s and 50s and keen to make a mark and to deliver some impressive returns. We're certainly going to give it our best shot. So I do think I wanted to highlight one of the things that struck me was that for a company that had an awful lot of people, we've got sort of there aren't many sort of 5 million market cap companies with 200 staff. And they didn't really have any structured program to buy shares. So we implemented 3 schemes. There's an all-employee share ownership plan that gives everyone the chance to buy shares. It's a tax-efficient scheme. It's a share incentive plan in law. So everyone can save between £10 and £150 a month out of their wages. We match the first £50. There are tax breaks if they keep their shares. 40% of the workforce took us up on it when we launched it. And so every month there's a purchase. It's around £7,000 a month, which isn't a lot by some standards, but for us that's a meaningful trade that happens every single month. And then there's over 30 members of the management team, so someone who's got some level of responsibility, where they use some of their employer pension contributions typically to buy shares using the workplace SIPs that everyone has. So those are new shares in the market. So although we do have a company share option plan, I think as an investor, sometimes you're a little skeptical about share options being a free ride on the share price, but you only get options if you are contractually committed to buying shares in the market to a certain percentage of your salary, and the minimum is 2.5%, and for quite a lot of people it's more than that. And so finally, the key reasons to invest. Firstly, just although we have a very small market cap, we fully intend to be committed to AIM. We want to get our market cap up out of this very low zone into the sort of the 50, 100 million level where you can start to talk to some of the smaller institutions. We hope we can persuade some private investors to come along for the first bit of that journey at least. We have a plan to use acquisitive growth. As the largest shareholder, I'm very conscious of not just growing for the sake of it. We want to make sure that there is a good progression of the share price. That matters to us. And the businesses can grow organically, but also there is a lot of complementary M&A activity we can do. And I suppose just lastly, that key point is that at the moment I feel that with a valuation that's kind of a quarter to a third of turnover, we're valued like the professional services company we've been and not like the technology business we're becoming. That most of the competitors in the building operating system space are billion-pound businesses that trade on large multiples of their revenue. And if I can get us somewhere along that journey while we're growing the revenue as well, then there's a compounding effect on the returns. That I think is my last slide. Happy to take questions. We do have a website where you can sign up if you'd like to receive details of RNSs and things, and to get in touch. We encourage you to look at that. Thank you all for your time.
Thank you very much. Questions, please.
So what's the main route into the building owners? Is it the CBREs of this world, or is it the insurance companies that own the buildings? And how long is the process from A to Z, from to getting a smart core in place and working?
Yeah, so it varies. At the moment, Smart Core is primarily for fit out for the new build and for significant fit out. There is certainly scope to retrofit and go and help existing property owners. We have a lot of contacts with developers through the architecture business. It's still a meaningful amount of of the business. We've got a lot of people who have a lot of contacts. And I think one of the attractions of us, unlike a regular a PropTech that is coming to this clean, is that you've got to go and try and meet all these people, and we already know them. They're in our building daily, talking about their next project, and a lot of this is quite long term. This is why I think AIM is a much better place for us than being VC backed, where there's a fund with a finite life. We make steady progress, but some buildings will take years to deploy. So the skyscraper that we announced the sale of SmartCore to last summer, that project is still not live. They've bought the software, but it's a construction site. It takes years to build. So it is. The property industry is much slower than tech cycles are used to. I think that the two have a lot to learn from each other.
Cheers. I mean, that was really, really interesting. You mentioned that your 50% of your revenue is coming from technology, and from what I understand of what you've presented, you're effectively placing your technology on top of the other service technology that's already sat there. So effectively an aggregator of data that is already being produced by the different systems within the building. That makes you very replaceable very quickly through, because obviously it's a standard APIs and things. So what's your USP? What stops someone coming in and saying, I can aggregate that data at a cheaper cost? What's the thing that keeps you there, and what's your USP?
So I guess as a building operating system, it's a lot more than just a data aggregator. It's about the control systems, and it's not just doing the analysis. That's just a small part of what we do. So yeah, there are lots of people who come and analyze your data, but actually you want AI to run your building for you. My go-to example about smart buildings is like, if you're a law firm and the meeting room booking system knows no one's in your building on a Friday, tell the heating system so you don't heat the building or cool the building or whatever it needs to be. But the reality is it's not no one's in, it's a few people are in, and the utilization's way down on a Thursday. So what you do, what bits of the building you heat, for how long, to what extent, will depend on lots of things, potentially including, frankly, how important that person, if it's a really important client coming in, or if it's some people who work there and could just be told to put a jumper on. You having that information on your phone about this floor's going to be at this temperature today will matter to some people. We're much more than just data aggregation, and also we're the GDPR element of that, like the right to be forgotten, to say, actually, I want my data removing or anonymizing, how to manage that when some of the data is held by the landlord and some by the tenant. There needs to be appropriate sharing. All of that stuff is not dealt with. There are a handful of other building operating system companies out there. They are billion-pound businesses, but almost every building doesn't have one yet. So in that sense, it's an open field. So I feel we've got a reasonable chance. I don't know how close to being a billion-pound business we can get, but we'll give it a shot. And there is a there is a substantial market opportunity here that we would like to try and capture.
I'm going to start at the front and work back. There's all three there.
I absolutely love this sector and, the power that it has. But in terms of actually digesting what you are doing and how you're using this new technology, I was yearning for some video. I wanted to see the image, not very populated slides that are very difficult to really quickly understand. Because what I'm going to do at home later on, I'm going to seek illustration, video, moving image that actually illustrates what you are actually telling us. And that, I'm really always surprised, if I can generalize, that in presentation, the use of video and moving image is lacking everywhere because you put so much text on the screen, I'm not able to follow it. That's my plea at the same time as, the power of the moving image that you can use as a vehicle for presenting.
I think feedback very much noted for next time.
Thank you. We're quite early in the stage of talking to investors. I think the first stage was to make sure that the staff are buying shares and show that we have confidence in what we're doing. And so we're now starting to reach the wider market, and that's useful feedback. Thank you.
Yeah. What valuation limits do you apply to acquisitions?
Good question. I mean, it really depends where the share price is as to what we can do. One of the challenges is that a lot of private companies have valuations that just seem crazy compared to the public markets. And so, Freddie mentioned Vanti was a very good example. They got quite close to raising money in 2023 on a £12 million valuation with 4 million of revenue. And they didn't quite make it for various reasons and went into liquidation. And we've paid £37,000 for that. And it has added 2 or 3 million to our revenue in the current financial year.
Absolutely. I think we're somewhat opportunistic with this as well in terms of what can go there in terms of the cheap map as well. And the appetite of the companies that we're looking at, we've been in multiple discussions in the past, and at the moment the appetite for people to come on board who share this vision, and we do it share for share, just makes it much more palatable for people involved.
Yeah, so EcoDriver was a good example of a solvent acquisition where the valuation so that was a firm that we bought on about 1 times revenue. There is a firm with half their revenue. So that at the time, that was like a £400,000 business with 400,000 of revenue. And there's a competitor of theirs I'm aware of that has half their revenue, and their last round was at £5 million. And we clearly can't buy on those valuations, but we don't need to. So one of the reasons on the tube map we're being a bit opportunistic is we have to find things that are good value for shareholders because that matters.
Yeah, I mean, you'll need to find things that make a profit if you want to raise more money from AIM shareholders. So it's more than just sales.
Yeah, I mean, I think yes, you're right. But there is a very large growth opportunity, and if you can grow faster if you're generating recurring revenues or long-term revenues, then you've got all of the cost of that sale up front. So you can, if you were to maximize your profit, you would grow much slower. So while we need to make a profit for sure, if we focus on maximizing the short-term profit, we will grow much slower. And there's a danger. So one of the attractions with Smart Core, unlike architecture, if you want to do 10 times as much architecture, you need 10 times as many architects. If you want to sell 10 times as many building operating system licenses at £100,000 a time, you don't need 10 times as many developers. But we do need more developers than we have today, although AI will move the needle on that very significantly compared to trying to do this 10 years ago, say.
Thank you.
Thank you.
Yeah, so I guess, I mean, I worked in a SaaS-based business. So I guess your earnings come from 2 sources. One is the tech side of it, so running the PropTech, the software license, so your ARR, annual revenue, recurring revenue. And then you have the professional services element, which is integrating your APIs with the hundreds of other other providers in any client side, right? How fast is your SaaS-based license, your software license side of the business growing versus your one-time integration into each of these clients?
Yeah.
Is it growing significantly?
Recurring revenue. I mean, based on where we were 2 years ago when we started this journey with BUC Cybernetics and Aukett Swanke, it was just under £1 million of recurring revenue, whereas we're at the £2 million point now. So it's fast growth, and obviously we've got high retention rates as well. So it's not quite exponential, but it's a very fast up trajectory there.
And what's the term usually? How long are the terms on your recurring revenue? Is it 3 years, 5 years?
For us now is to try and get everything on 3 years. I would say, however, over 50% is 1 year at the moment, but on a renewal basis, it's 1, 3 or 5.
I think the reality is that most property, it is quite sticky. Almost everyone renews. It's got very high renewal rates. But also, the slightly complicated bit of the message is that not all of this is SaaS. That some of it is stuff that sits. We're not just a software company. There's proper engineering here. The software is deployed in the building. It's an asset of the building. A lot of people don't think through, well, what happens if the SaaS provider isn't there? If you're trying to sell to a customer, they should think through what happens to the SaaS provider. When Vanti, the firm that we acquired, went bust, there was one client in particular that had significant international assets that, because they were wedded to a SaaS model, it was then a huge problem when that company had gone, the provider had gone bust, that their doors in offices overseas were going to stop working. And it's just poor engineering to insist on purchasing on a SaaS basis. And we kept it going, but I think it is important to recognize the limitations of SaaS, and that actually the traditional model of software, where you charge a big chunk up front and then you provide an assurance model, but the software keeps going even if you're not there, is quite good. One of the downsides of SaaS is that it takes ages to get the revenue going, because you make the sale, but you only recognize the revenue for the remaining months of that financial year. Whereas if you can do a traditional software model where you charge a big chunk up front, and then you charge for support and assurance, that's a pretty nice commercial model. I think works better, and it's better engineering.
Sorry, just a lead-on question. Are you looking at other opportunities other than the licensing and the onboarding, what I would call the implementation onboarding element? For example, manage as a service, data as a service.
Yes, absolutely. A lot of the revenue at the moment is, so for example, the £200,000 license for SmartCore was part of a £750,000 contract. So, and traditionally, without Vanti, before we bought SmartCore, we would have only made the £550,000 one-off sale. But now we're adding on a £200,000 license and then further assurance, and they're pretty much wedded to you because they're not going to go elsewhere.
The insurance contract for that one is £85,000 on a 3-year contract as well.
So an example would be, they bought a SmartCore. Now, SmartCore provides that key element, managing the different providers.
Use my phone, people.
Sorry. So SmartCore provides that base element, but then providing them with software that then, data mining, for example, ability to mine their data, give them additional, meaning or, into understanding their data and therefore,
Yes,
that's all available. Okay.
Do you mind if you attack them at the break? Because I've got one question that I want to ask before closing, and we're out of time, which is you're a 6 million market cap. You've got a target of being 50 million market cap. Can you just talk us a little bit in terms of debt and equity through what that plan looks like?
Yeah, we don't have a lot of debt at the moment. If we do acquisitions that are solidly profitable, then some debt may be appropriate to help fund those. But essentially, we want to make this primarily an equity play. Using the quote, we want to be. I think investors have been burnt too many times in relatively small AIM companies that take on too much debt, and we're wary of falling into that trap. And just the fear of it puts investors off. So we would like to be equity based. And I would hope that we can find some pretty good value acquisitions like Vanti, where we really haven't paid very much for something that very quickly is of a very substantial value. There's quite a lot of businesses where venture capital has come in and got bored because they didn't see the sort of hockey stick return. And it's not quite managing to be a business, but as a bolt-on to us, where we can take the customer base and put it onto our platform and just have recurring revenue, the incremental revenue. I think we can add significantly to our value and our profitability.
Thank you. I also wanted to ask about marketing strategy and integration, how you integrate the firms that you're buying, but it's not fair to stop other people's questions. So that'll be a wine and buffet question.
Thank you.
So Nicholas, Freddie, thank you very much indeed.
Thank you.